In this session, we're going to take our first look at syllabus section E, which is performance evaluation and corporate failure. A couple of main areas in this particular section of the syllabus that we look at. We'll start off in this session looking at a few of the models which are used as a framework for assessing performance. Things like Balanced Scorecard, the performance pyramid, building block model of Fitzgerald and Moon, and the performance prism. And then we do, in the next session, we'll look at activity-based management, so some revision of activity-based costing and the various applications that that has in the P5 paper. All of this is very, very examinable, so I would suggest making sure that, of all the models we look at, you're comfortable about the basic structure of them. Okay, let's start off then by having a reminder of the Balanced Scorecard. Now, the Balanced Scorecard, put together by Kaplan and Norton in the early 90s, and what they were considering is trying to get a rounded view of performance of an organisation by looking at 4 different aspects. You've got the traditional financial aspect, customer-related factors, internal business processes, and innovation and learning. And this follows on from something we've talked about earlier, which is widely recognised that financial performance measures are very good at telling you what you're doing at the moment and what you've done in the past, but the other aspects of your performance, i.e. the future, is likely to come more from looking at how you're performing in relation to your customers, to your internal processes, and how well you're developing your business through new products and so on, so innovation and learning. And Kaplan and Norton said that ultimately it's the customer that is critical. So the customer drives all of your future success. It will drive you having to improve your internal processes. It will drive you having to innovate new products. So they said for the future you've got to make sure that the customer measures are paramount on your radar when you're assessing the performance of the business. Now, if we just take a little look at an illustration of the model over the page, we can see from this that in looking at the overall vision and strategy of the organisation, we've got our 4 aspects of performance: financial, customer, internal business processes, and innovation and learning. And when we look at each one, the financial measures will be a lot of your classic sort of shareholder-based measures. We look at cash flow generation, we look at profit margins, return on capital employed, earnings per share, just look at general growth in profits and revenues. So nothing really tricky to understand in there, just a load of your classic financial performance indicators. When we look at the customers, we've got to try and measure things that we know customers value. So that might include trying to monitor whether we are achieving delivery times, delivery quantities, and delivery quality. That could require us to monitor complaints. That might be absolute number of complaints. It might be looking at increases in number of complaints or number of complaints per item sold. There's some other obvious ones like percentage of on-time deliveries should be a fairly easy one to measure and monitor. Look at what sort of percentage of your products get returned. What's your customer retention rate like? So if it tells you information about the churn rate, i.e. the rate at which your customers are leaving you, then obviously you want to try and keep that to a minimum. And what sort of percentage warranty claims are people making, i.e. you've sold them something, there's found to be something wrong with that item and they've made a claim under warranty. Those are some of the classic, but not an exhaustive list of all the things you could measure with regards to your customers. When looking at internal business processes, i.e. what do we need to be able to do internally in order to make sure we minimise complaints or we get deliveries on time, etc., etc. Well, we've got to have good quality control, so we could look at quality control reject rates to see whether the quality of what we're making is suitable. We could look at things like turnaround time. How quickly have we been able to turn a customer's order into an item coming off the production line, and also setup times. If you're in a kind of traditional manufacturing scenario, you might want to look at how quickly you can get the production line set up and moving if a customer order is placed. Again, not the only things that you could have there, but you get the idea. Anything that we could do internally to speed up and make the quality better, then we should come up with a measure around that. And then with the innovation and learning, this is really looking at where we're going to get the future value from. Now, the first couple might seem a little bit odd, things like staff turnover and illness rates, but if you've got high staff turnover, it means obviously you're losing the intellectual knowledge in your organisation on a fairly regular basis, and that's going to mean people have to be retrained, and that's going to take the focus off being able to develop new products and new ideas. We could look at a few classic things like the development time for new products, percentage of revenue that comes from products launched in the last couple of years. That will give you an idea of whether you're keeping the momentum going with regards to developing new products. So the Balanced Scorecard does provide a pretty robust framework within which an organisation can monitor all key aspects of their business performance. So people like the National Health Service, the NHS in the UK, use a version of the Balanced Scorecard to help monitor their performance. That's just one type of model. The next model we'll look at is the Fitzgerald and Moon building block model, which considers performance in service-based businesses. So what Fitzgerald and Moon said is, with a service-based business, we consider 3 building blocks in the overall performance measurement system. Now, if we take the bottom 2 blocks at the moment, standards and rewards, the standards look at the characteristics that the system should have, and the rewards look at the benefits of having a structured approach like this. So, for example, if we take a look at the first standard here, ownership. Okay, so one of the characteristics that a good performance management system should have is that it should be implemented in such a way that people take ownership for their performance. And if they do that, the reward should be that the reward system is very clear as to who's going to get what if certain achievements are made. Achievability. Okay, the performance system should be achievable. It should be possible for people to hit their targets, and that's likely to result in a reward of motivation, that you're going to get motivated staff if you've set a performance appraisal system that is deemed to be achievable. Equity in this context just simply means fairness. So the system should be fair, and that should allow controllability, in that if it's deemed to be fair, then people can't claim that they couldn't do anything about the system, and that they should be able to therefore control their own performance and whether or not they do or don't get their bonuses and rewards. So that's some of the kind of the underpinning building blocks to the overall system. What then Fitzgerald and Moon said was that there are 6 aspects of performance that you might want to monitor in a service-based business. There's the usual classics: profitability, things like earnings per share, increases in profit, etc., etc. You've got competitiveness. So you might look at things like their market share and so on. So you could argue almost any business could measure those things, but they then said that specifically for service-based businesses, importance of things like flexibility. Imagine you're a firm of accountants and you want to monitor how flexible you're being with regards to your clients. So if a client rang up and wanted a specific piece of work done tomorrow, could you organise your resources internally in order to do that? So how flexible are your staff adapting to sort of changing needs of customers? Innovation. Are you coming up with new products or new ideas? Again, a firm of accountants might come up with a new, slightly more efficient way of performing an audit. There might be more IT related or use of software to help speed up the audit process and make things more efficient for the client. Is the firm of accountants developing a new arm to it? So is it adding in insolvency assistance, whereas traditionally it was just offering accountancy and assurance advice? Has it now added tax into its portfolio of client work that it performs? So innovation, coming up with new ideas or new parts to your business that are going to be more useful overall for the clients. Resource utilization. Well, if you do work for a firm of accountants, you'll know that things like the percentage chargeable time is going to be important. For us, we're in a service-based business, so we would look at a number of tutor days in the classroom. Given that people are the main resource in a service-based business, then the utilisation of the people needs to be measured, because you don't want to end up carrying too much headcount for the level of work you've got. And then finally, excellence and quality. We'll look at awards that might have been won, so industry awards, or for us things like having platinum status for ACCA. That's an important stamp of quality because it's externally assessed. There's a whole host of criteria that one has to meet in order to be platinum status with the ACCA, including pass rates and general student support. So that is a good measure of quality or excellence in that marketplace. The award we won last year for College of the Year with PQ magazine, that's a nice other external stamp of approval as well. So you can see how a service-based business, a people-based business, might want to focus on those 6 dimensions. In an exam, that can provide you with quite a useful set of ideas for coming up with suggested performance measures in the organisation in the question. Okay, if we now take a look at the performance pyramid. The performance pyramid of McNair, Lynch and Cross really builds on something we have also talked about earlier, which is that when you're objective setting within an organisation, you've got to have consistency up and down the organisation and within the individual tiers within an organisation. So McNair, Lynch and Cross say, look at the sort of operational level of your organisation. You will need to monitor performance with regards to quality, delivery, process times and cost and wastage. So on a day-to-day basis you can look at number of quality rejects, the percentage of deliveries that are on time, how fast you're turning inputs into outputs with your process time, and what sort of wastage levels there are. So things that we know are important on a day-to-day basis. Those should then drive the sort of tactical or mid-tier objectives, i.e. in the sort of more medium term, you're looking to monitor customer satisfaction, flexibility and productivity, and customer satisfaction will come out of the sort of quality and delivery success. Flexibility will come out of your ability to deliver fast and the sort of process times and so on. And as you go up the organisation to sort of strategic levels, you'll be more concerned with measures of market satisfaction, so your market share and things like that, as well as the financial measures. And if you've got consistency across the organisation and up and down the organisation, then you should find that ultimately your performance is improved. If, however, you're inconsistent anywhere, so for example you are producing high quality products, so the reject rates are very low because you've got high quality products, but your distribution and delivery is then a load of rubbish, then you're not going to get the customer satisfaction. So you've got to have these things working together to build up the organisation to satisfied customers and ultimately market satisfaction and financial success. And the final model we need to be aware of from a performance perspective in this paper that's specifically mentioned is the Performance Prism by Neely and Adams. So Neely and Adams' Performance Prism looks at 5 different aspects, perspectives that will help the board of directors understand overall performance needs in the organisation. We start off with the 5 different facets of this prism. Apologies for the inability to draw it brilliantly, but you've got basically a shape with 5 sides and 1 side for each of the facets of this prism. The top facet, stakeholder satisfaction. You're asking yourself here, what is expected of us from our most important stakeholders? So what returns do shareholders want? What would be acceptable performance from a customer's perspective? So that drives everything else. We've got to think, what is it going to be acceptable to our key stakeholders? That's then supported by the strategies we adopt. So how are we going to achieve these desired performance targets from the stakeholders' perspective? Might it be that what we could do is we could consider buying some of our materials from overseas to reduce the input costs, which will improve profits for shareholders? Might we be changing suppliers in order to buy higher quality items so that we can give customers slightly better quality products? Those sort of things. It's what strategies are we going to adopt to deliver what the stakeholders are really after. Then we look at our internal processes. How are we going to manage our internal processes in order to support the strategies that we've come up with in part 2? So if we're going to be buying materials from overseas to reduce input costs, how are we going to do that? Are we going to have somebody whose job it is to do a sort of beauty parade of foreign suppliers and then continually monitor their pricing and their quality levels? So might we need regular retendering of supplier prices to get best value? Over the page we've got the 4th supporting facet here, the capabilities. What resources do we need in place to successfully operate the processes that are going to help deliver us value? So are we going to need to recruit a specialist procurement or purchasing person in order to do the beauty parade with foreign suppliers, in order to get the better prices, in order to improve profits? And the bottom facet, this looks at what do we need back from our stakeholders in order for us to maintain the sort of supporting facets, i.e., if we're going to need money, we're going to need capital investment from shareholders or banks. We're going to need loyalty from our customers. We're going to need information from our suppliers, and their technology is going to need to be sufficient so that we can access information that we might need on their prices and delivery times and lead times. So the bottom facet kind of supports what we know we need to do in the middle 3 supporting facets, which ultimately will drive the stakeholder satisfaction, which is the top facet. So there is obviously some logic to this, but I think if you step back from the model and just think in terms of common sense, it makes reasonable sense that you've got certain things that your stakeholders want. You look at how you're going to do it, what resources, what processes and what strategy you're going to use to deliver that performance, and what higher level resources do you need from your stakeholders to help you do that in terms of money and loyalty and so on. Okay, so that's looked at a few of the kind of key models. In the next session we're going to take a look at activity-based management, or the first part of activity-based management.